Hi, this is Aishwarya. Welcome to my YouTube channel. I will be posting a series of videos teaching accountancy for class 11 under CBSE syllabus. So in this video, let's begin with the first chapter, which is Introduction to Accounting Part 1. I will be covering the following topics. So accountancy is a new subject for you all. You wouldn't have done this before. So let's see what is accounting with a small example. So I suppose you all must have been receiving pocket money from your parents, right? So at the beginning of the month, your parents might be giving you some amount which you will spend on your various expenses, and at the end if something is remaining, you will save. So keeping a track of what comes in, where all it goes and how much is remaining is nothing but maintaining a pocket money account. So when it comes to a company or an organization, they get in money through various sources and they'll also spend it on various expenses. So keeping a track of all this is accounting. Okay. Let's see the meaning of accounting. So accounting is recording of all the daily transaction. Every single rupee that comes in and goes out of a business should be recorded. So that's why it is called a language where every business speaks. Because end of the end of the day, the financial reports will speak about the health of the business. Okay, so let's see what is the accounting process. So it's a flowchart given in your textbook. So it all starts with economic events. So economic events is nothing but an event that is monetary in nature. So we'll see this in detail in the forthcoming topics. So any event that has got to do with money is an economic event. So when money is involved, you have to record, that is the accounting process. So after the accounting is done, it has to be communicated to the interested parties or the managers of the company, the decision makers, and based on that, they will again make decisions of economic events. So it is an ongoing process. So let's see this with an example. Supposing a company which is manufacturing chocolates wants to introduce a new flavor of chocolate. So that is an economic event because that involves a lot of cost in manufacturing and bringing it to the market available for the customer. So once the product is being sold, so the money is accounted, all the expenses and the income is being accounted, and profit or loss is communicated to the decision makers of the company. So based on that, what decisions they make, whether to continue producing the new flavor or should they stop or should they produce more, which is again an economic event that involves money in it. So this is an ongoing process. Now let's see what is economic event in detail. So economic event is an event that is measurable in monetary terms. So for example, I wash my car all by myself. It's not an economic event. Or I hire a person to wash my car and I pay him a salary for that. Then that is said to be an economic event. Why? Because money is involved. I pay him salary, right? In the same way, when it comes to a company, there's so many events that is happening, and where all money is involved, you name it as economic event. The example given in your textbook is purchase of machinery, which involves buying, transporting, installing and trial runs. All this involves specific cost. So that is a bundle of economic events. Okay, so economic events are of two types, which is external and internal. Now let's assume there's a company A. Okay, so this company wants to produce some product. So for that it will need to buy raw materials from a supplier S. So the supplier S supplies the raw material and A pays money to the supplier S, which is an economic event, right? And the same company, after producing the product, it will sell it to its customers. The customer will pay money to the company. Again, money is involved. This is also an economic event. The A has rented a premises to run its business and it has to pay rent to its landlord. Here again money is involved. This is also an economic event, right? But all this economic event, if you see, it is all with the external parties to the company. And that's why all these are called external economic events. Supposing same company A. Okay, it has various departments inside the company. Say purchase department, production department, sales department, and accounts department. So there will be transactions happening amongst these departments. Like the purchase department will supply raw materials to the production department, okay, and the accounts department will pay wages to the employees, or after production department will send their finished goods to the sales department, or the overhead cost, that is the extra expenses, will be allocated among all the departments. So all these are transactions that is happening inside the company, within the company, and all these are economic events because it involves money. So that is why it is called internal events, right? Then we'll go to the definition. There are two definitions that is given in the textbook. So identifying, measuring, communicating, recording, classifying, summarizing, all this is accountancy. We'll see that in detail. The four pillars of accounting. So first you have to identify a transaction, and you have to check if it is monetary measurable. If it satisfies these two conditions, then you have to record, and then you have to communicate. So let's see this in detail. First you have to identify the transaction. What sort of a transaction has to be recorded? You have to check if the event is financial in nature. So supposing an employee leaves the company, that cannot be recorded in the books of accounts because money is not involved there. Supposing there is a change in the policy of the company, they have changed the timings of the company, again that will not find place in the books of accounts. Okay, if any event where money is involved and it can be measured in monetary terms, then such event has to be recorded in the books of accounts. Now how do you record? Recording should be in chronological order according to the dates. Supposing I record all the transaction happening today, and suddenly I remember that an event happened 2 days before which I have forgotten to record. I put today's date and record, then that will not be a proper recording method, because end of the day if I generate a report, that will not give me a exact result of what has happened today because there is a backdated transaction. And again, if you're recording a transaction, it has to be in the same currency. Okay, if your company is Indian company, you can record in rupees. If your company is a multinational company having provisos in various countries, you can convert them into a common currency, say dollars, and then record in order to get the financial results in one particular currency. And then when you're recording, you have to record in a way which is well established and accepted accounting practices. Okay, you cannot record the way you want, like how you record your pocket money, because the final report has to be communicated to the end users. So you have to prepare in such a way that they are able to understand, right? So usually the reports are prepared daily, weekly, monthly, annually for the users. Now let's see who are these users. Okay, again users are classified into two types: internal users and external users. Internal users are those who are inside the company, say CEO, managing director, finance officer, various heads of the departments. All these are the internal users of the report. Who are the external users? People who have invested in the company, like investors, or banks and creditors who have given debts or lent to the company, and other tax authorities, government authorities. All these are the external users of the financial reports of the company. Now let's see what sort of usage these people have. Okay, now owners who have put in their capital, so they will check on return on investment. So since they have invested, they'll expect some return out of it, right? So they will check for return on investment, and they will also check for the financial health of the company. And then the directors or managers who are inside the company, they will also check for the return on investment, and they will check if the company is making enough profits, and then they will also check if the company is meeting towards all its goals, okay, and if all their planned strategies are working. So for that they will use the financial reports. And then the creditors, people who have lent, they will check if their money is going to come back, okay, if the company is capable of paying them back within the stipulated period. And they will also assess the liquidity. They will check if the company is capable of meeting its uh, immediate expenses, okay, all these they will check. And then prospective investors. Now who are prospective investors? Investors who will check the financial report and see if the company is able to make good future profits, if they're able to grow. And then such investors will invest their money in the company in order to get good returns on their investments. So those are the prospective investors. And then comes governments and regulators. So all these tax authorities, income tax, GST, VAT, and registrar of companies, SEBI, Security Exchange Board of India, and other legal uh, organizations who wants to check if the company has computed their profits properly, paid the tax, enough tax on time, and if they'll also want to check if the company has followed all the rules and regulations. So in such a way these people will have a track of all the financial reports of the companies. And then comes organization. Organization is a small topic that is there in between, just the meaning. So we'll see what is organization. Organization can be anything: a sole proprietorship, a business run by a single person, or it can be a partnership firm where two or more people join hands and run a partnership firm. Mostly it is auditing firms, law firms, you can see they'll be of partnership firm. And then companies, public company, private company, again they come under the scope of organization. Local authorities, government authorities, all the public bodies, they are also organization. Banks, your cooperative society, association of persons, all these come under the umbrella of organization. So with these we come to the end of the video. The same video has also been explained in Tamil. I will put the link in the description. If you have any doubt, please post in the comment section. If you like this video, share it with your friends and subscribe to my channel. Thank you. Bye bye.